First of all, I would like to thank you, all of you. This month, we have crossed 5 lakh crore AUM, and we manage money for more than 65 lakh unique investors. This journey would not have been possible without support from all of you. So thank you very much. Our success is as much as your success. Coming to global economy, while with President Trump, tariff war has become more popular, globally, trade restrictions has been rising steadily as World Trade Organization failed to deliver on its mandate. Inflation all over the world is showing signs of easing, allowing central banks to cut rates. Some banks like ECB may cut more rates. Some like Bank of Japan may actually raise rates. But most of the central banks are on the easing mode. This is driven by debt burden globally, which is becoming a fairly large number at $300 trillion plus. US Fed is on its way to cut about 75 basis points. Eurozone is almost double of that at 1.5%. And Japan may be looking to raise rates. China continues to remain a miracle economy. Their trade surplus this year is likely to touch $1 trillion. No other country has ever achieved that miracle. China is also a miracle economy in the sense their private credit to GDP ratio remains on a higher side. And despite having no democracy or election like democratic countries, China is announcing handouts for poor people, probably reflecting that there are fault lines. Coming to US economy, Fed has moved over last 4 years from inflation is transitory to recession is needed to lower inflation to we need 50 basis point rate cut to avoid a recession. Fed has changed its communication and stance fairly rapidly. But I guess Fed was doing that to maintain a delicate balance between growth and inflation. Fed increased interest rates dramatically and lowered liquidity in a calibrated manner to ensure that inflation comes down and American growth does not turn into recession. Fed, by and large, has done a fantastic job with inflation coming down and GDP still remaining strong. Obviously, every medicine has a side effect. US debt दिन दोगुना रात चौगुना बढ़ रहा है. Their debt, as we speak, is crossing $36 trillion. And there is a need for debt because every dollar of incremental debt produces just about 58 cents of GDP. Obviously, America is leveraged. Now, one way to reduce leverage is to reduce deficit. But both President Trump and President Biden has run one of the highest peacetime deficit. The announcements made by both the candidates in the presidential election does not give much hope on deficit reduction. US economy is driven by consumerism. Consumption is 2/3 of their GDP. US households' wealth is invested into stock market. almost half of their wealth is in stock market. If stock market goes down, wealth effect disappears, consumption will come down. It is imperative for the new administration to keep American stock market elevated. The challenge with US stock market is it's heavily concentrated in large companies. Top 10 companies like Microsoft, Apple, Nvidia, Alphabet contributes 37% of S&P 500's market cap. And these companies are now witnessing deceleration in earning. Will earnings deceleration impact prices? One has to see. Many Americans are optimistic about all-time high American market going further up. But on a fundamental basis, emerging market today are better placed than American market in terms of growth. Will American investors be right? Or will fundamentals be right? We have to watch. President Trump is making announcement of its team members, and that has also kind of led to speculation about what policy they will follow. Normally in US, first 2 years are heavy load. You try to do as much work as possible in first 2 years. After midterm election in House and Senate, you generally try to slow down. We believe US will focus on America first. They will divide rest of the world in allies, non-aligned, and enemies. They will focus on improving government efficiency by cutting expenditure. And they are talking about trillions of dollars in spending. They are threatening levy of tariffs, deregulation and tax cuts, and onshoring of key technologies. ESG norms will go for a toss. Drill, baby, drill will become norm for non-renewable energy. Diversity, equity, inclusion also will probably take a backseat. Now, for us, events which will matter, will Europe and Middle East see end of hostility, or there will be one more war in Asia? Second, whether Fed will cut rates under pressure or keep it high to ward off inflationary import tariffs. The past has shown that tariff war does not necessarily hurt only the exporting country. It also hurts importing country in terms of higher inflation, lower consumption power, and most importantly, lower profitability. Coming to Indian economy, despite second quarter GDP number coming well below expectation, we still believe our economy is oasis in the global desert. Headline numbers other than for second quarter GDP has been positive. We look well poised compared to our peers. Economic activity are near all-time high level. Capacity utilization is robust. Kharif production is likely to grow by about 5.7%, with sharp increases in rice, maize, oilseeds, and paddy. Thanks to bumper Kharif crop, rural demand is outpacing urban demand, reflected in tractor sales and two-wheeler sales. Rabi crop omens are good as water level in reservoir is above 10-year average. Oil prices continue to remain subdued And with President Trump coming in, there is fear that oil prices will go further down. India's balance of payment remains in a healthy position thanks to lower oil prices. Government finances remain robust on tax collection and lower spending. The bad news was dip in second quarter GDP at about 5.4%. It prompted RBI to revise FY25 GDP growth target from 7.2% to 6.6%. It also pushed RBI to increase inflation estimate from 4.5% to 4.8%. Growth falling, inflation rising. Is India in stagflation? Answer is undoubtedly no. Despite this correction, we will remain one of the fastest growing major economy in the world. Signs of September slowdown were visible. Cement volume grew negatively in August. PV sales were negative for July, August, and September. Power generation dropped negatively in August. Diesel sales degrew in August. All these signs were pointing that second quarter FY25 GDP will be lower than expected. I'm sure all of you will remember this slide, which we have been carrying since last two of our presentations. The GST collection continued to grow below nominal GDP growth, indicating broad-based weakness in the market. October-November has begun on a good note. Festival season from Diwali to Christmas is boosting consumption. I'm sure all of you have received multiple wedding invites. There are about 50 lakh wedding happenings in India, which will result into spending of about 6 lakh crore. And most importantly, in the first half, government could spend only 69,000 crore a month on capex, partly because of election season in April to July. In order to achieve budgeted target of 11,11,000 crore, government will have to pick up the pace to reach 1,16,000 crore a month. We believe government will put all effort to spend this money on capex, and that should support economy. Between festival season, wedding, and government spending, we believe economy in second half will be better than first half. Our biggest opportunity remains China plus one. Under President Trump, there will be more tariffs levied on China, and we should leverage that to provide as much goods and services as possible to America. Our challenge remains on unemployment side. While the numbers have started coming down, there is probably disguised unemployment in agriculture, and hence capturing China plus one opportunity becomes very, very critical. Converting this subdued second quarter but optimistic second half in the equity market, market cap to GDP ratio remains high at 136%. Historical average is about 85%. We think markets are unlikely to revert to 85% market cap to GDP ratio because profitability has been strong. Between 2020 to 2024, profit grew by 257%, pushing market cap growth of 241%. With this kind of profitability, we feel market cap to GDP ratio will remain elevated and unlikely to mean revert in the near term. In simple language, 25,000 की निफ्टी 17-18,000 पे आए वो कम लगता है. Valuation wise, large cap, mid cap, small cap remains at a premium. Large caps are at a small premium of 10%. and can easily be explained by entry of 100 PE stocks like Titan and Trent and now Zomato. Mid-cap and small caps are at slightly higher premium to historical average, but certainly all this looks reasonable, keeping in mind that low PE stocks have gone out of index and high PE stocks are entering. Second quarter FY25 corporate results were subdued, largely driven by drop in mid-caps, where against profit growth of 2.5%, actual number came at minus 9.6%. Despite that subdued drop, market is well on its course to achieve EPS expectation. In the first half, EPS has come at about 570 rupees, and the expectation is 1059 for second half. I'm sure with this kind of numbers, this 489 rupees EPS in second half is easily achievable. FPIs have been big sellers in October and November. They sold close to about $13 billion net of primary market flows. While the amounts are large, as a percentage of market cap, it's fairly small. And if you remember two of my comments, सुबह का भूला शाम को घर लौट आएगा, and आएंगे तो दुगना लगान देना पड़ेगा. With this kind of December, we may have to say FPIs सुबह का भूला दोपहर को ही घर लौट आया. Outflows were witnessed in China ETF also. So most probably money was going to US. US entry was quite understandable. American markets were likely to go up on President Trump's tax cuts. Our markets were likely to fall on FPI selling and valuation. And rupee was going to depreciate little bit because of outflows. Now this trade is almost over. Dow Jones has moved up, Nifty has come down and bottomed, and rupee is depreciating, but not much left from here onwards. Obviously now this trade is coming to an end, and which is where we have seen buying by FPIs in December. They are also buying because their holding in Indian equity market is at nearly decadal low level. They are now underweight India against 19.5% odd weight in MSCI Emerging Market Index. Their actual holding is coming at around 16%. If we look at our comparison vis-a-vis China and America, Chinese markets have jumped about 35% from the bottom. American markets have run up 16% in recent times, whereas we were down about 10%. Despite 35% bounce back, China is trading where 17 years before it was trading. We are trading where we were 4 months before. The PE ratio for China is about 15.6, and for us it is about 22.6, whereas American PE is much higher at 27 times. Chinese earning per share has grown about 11% in last 10 years. American earning per share has grown about 94% in last 10 years. And Indian EPS has grown by about 166% in last 10 years. Obviously, China EPS has grown in renminbi terms, US dollar for US and rupee for India. So they are not direct comparison, but it does show that India's corporate profitability is growing at a much faster pace than rest of the world. Overall, we believe market is positively discounting Fed cuts, continuity of government, especially after Maharashtra election results, oil prices remaining subdued with President Trump announcing drill baby drill, consumption bouncing back, geopolitical risks settling down, and earnings growth continuing despite second quarter subduedness. We believe all these things is discounted by the market. And if that happens, markets will continue to rise. Our call remains like before, neutral weight equities, overweight large cap, and underweight small cap. The most important thing for us is to moderate return expectation of customers. 309 out of BSE 500 stocks have doubled in last 5 years. That's a very, very broad-based rally. 181 stocks in BSE 500 trades above 50p. They were 1/3 at 79 5 years back. The 5-year return from Jan 20 to November 24 is about 18%. Small and mid cap about 27%. Large cap about 16%. But 15 years before that, small cap return was just 7.5%, less than 1/3 of what it had delivered in last 5 years. The broad market return was about 11%, little more than half of what you got in last 5 years. Going forward, investors will expect this kind of return and will have to probably drive them towards this kind of return. So it will be important to tell our investors, please moderate return expectation. This kind of broad-based rally is almost over. Sectorally, private banks looks attractive at below historical average valuation. Automobile looks attractive at below historical average valuation, despite some drop in momentum in December over festival season in car sales. Technology trades at a premium to historical average, but with President Trump cutting rates, there are chances that savings will be used for technology spend. Healthcare is trading little above historical average, but the earnings growth of healthcare sector probably justifies this. Cement is trading at historical average premium, trading above historical average premium, but that's because second quarter earnings were subdued as monsoon season disappears and real estate construction infra activity picks up, profitability will grow, and these numbers will look around historical average. Real estate looks little bit on the expensive side as it trades way above historical average. Telecom is trading above historical average, but do remember that for bulk of that historical average, telecom companies were making losses. It's only in recent times that they have started making money. Utilities trade above historical average. On a selective basis, there are opportunities. Capital goods trade way above historical average, and one will have to be extremely selective over there. Infrastructure trades above historical average, and again, one needs to exercise caution. Consumer durables, NBFCs also trade well above their historical average, and one will have to be cautious about the same. Oil and gas, PSU bank, consumer staples, specialty chemicals are neutral sectors. One will have to take a call based on bottom-up opportunities. Coming to Indian equity market, our SIPs continue to deliver, our equity schemes continue to deliver value to customers. On a rolling return basis, across almost all our equity funds across time periods, we have added value to investors. Same thing is true about our hybrid and other equity funds. When we compare point-to-point return, there are few funds where we may have underperformed index by a small margin on a 3-year basis, 5-year basis, but across all other time periods, we have delivered great return to investors, outperforming benchmark indices. The same is true for our other equity and hybrid funds. And if we look at SIP performance, again, the same story gets repeated, where across time periods, across various funds, we have by and large added value to our investors. Technology fund, we remain bullish as we believe there will be higher spending due to tax cuts in America, and companies leveraging artificial intelligence will be able to deliver faster, cheaper, better solutions to their customers. In banking and financial services, valuation is in your favor. For last 3-5 years, banks haven't done much on private side. We believe now valuations are reasonable, and with CRR cut, their profitability as well as deposit growth stroke liquidity will improve, and that should be a trigger for bank stocks to move higher. On the consumption side, as we mentioned earlier, rural consumption is picking up thanks to bumper Kharif and expected bumper Rabi. We believe companies focused on rural market and rural consumer product should do well in the days to come. Our equity schemes continue to do well, but few schemes where you should concentrate is equity opportunities, a blend of large and mid cap. Kotak Contra Fund, a blend of large, mid and small. Multi-cap fund, again a blend of large, mid and small. And Kotak Quant Fund, which is using computational power and data analytics to deliver better risk-adjusted return for our customers. We are also in the process of running our NFO of Transportation and Logistics Fund. It's closing for subscription on 9th December. Transportation and logistics is all pervasive, whether it's road, railway, sea, air. Everywhere transportation and logistics are needed to keep the wheels of this world moving. There are significant changes coming up in transport and logistics sector. For example, automobile is moving from diesel and petrol to CNG, hybrid and hydrogen. Auto ancillary is moving from casting, forging and precision engineering to assembly, mechanization and gigafactory. Transport means are moving from roads, railways, ports, airports to drones. And what was taking months is now taking minutes. By and large, transport sector fund has done well. A transport and logistics sector index has done well. It covers about 87% of market universe. Most of our funds which we have launched over last couple of years have done well for their customers. We look forward to your participation in this particular fund like before. Coming to fixed income, Fed is likely to cut rates by about 3 times or 75 basis points. We'll have to see how things evolve. Our rupee bonds continue to outperform US Treasury, driven by fiscal consolidation, which will ensure that there is less supply compared to the demand for gilts which people have. The food inflation, which pulled monthly inflation number above 6%, above RBI's tolerance range, is likely to decline post-harvest period. The RBI did revise inflation target to 4.8% for FY25, but in this Jan to March quarter, inflation will start easing off with the arrival of Kharif crop. RBI has managed liquidity quite well, and with the CRR cut, more liquidity will be added, to take care of any uncertainty. RBI is RBI is on its way to cut rates, but maybe they will need some comfort on the inflation side. This will be a shallow rate cut cycle. We expect at best 2 to 3 rate cuts in next year to support growth. This is time to buy longest possible duration. We have been saying that for some time. Many a times when we have pushed you to invest in longest maturity product, this is the time to go and invest into longest maturity product. There is one more exciting scheme which we are bringing from Kotak called Kotak Income Plus Arbitrage Fund of Fund. This is a great fund for saving on taxes. 60% of portfolio will be invested into debt fund. 40% portfolio will be invested into equity arbitrage fund. Together, they will ensure far less volatility than a pure debt fund, and it will be taxed at 12.5% after 2 years of holding period. So it is one of the most tax efficient instrument available for investors. We are seeing good traction in income and arbitrage fund. I hope all of you are aware of this fund and will take it to your customers. Hybrid debt schemes have also delivered good outperformance over benchmark index, and by and large, they have delivered great return to investors who invested in hybrid funds for systematic withdrawal plan. Our longest running fund is Kotak Multi-Asset Allocation Fund. If you had invested 1 crore since in inception 17 years back, you would have withdrawn at 7% return about 7 lakhs per year. That's about 84 lakhs in a year. And you will be still left with 3.5 crore as fund has delivered about 15-16% return compared to 7% withdrawal. These are the kind of products which you need to bring to the attention of customers. SIP, SWP probably is one of the best way to manage your cash flow requirement. On gold, we remain bullish since March 20. We were wrong in whole of 2021, but we realized that this was the gold has done very well since the COVID time, and we believe going forward also there is good run for gold. The gold prices are on a bull run as central banks are buying gold and replacing dollar or other assets with gold in their reserves. And it is still a very, very long journey because someone like China has less than 5%, 6% of their reserves in gold. If they have to reach someone like United States level, that will be multiple years buying program in gold. Gold prices also does well when US interest rates or US real interest rates come down, and we all know that US is expected to cut rates. Change or reduction in US interest rate also support gold prices, and we will see some spike in gold as US interest rate starts coming down further. Silver market has seen some amount of shortages for last 3-4 years, and that should keep silver prices supported in the days to come.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.